Top 10 warning signs a recession is coming. Are we heading toward another economic crash? In today's video, we were breaking down the top 10 signs that a recession might be right around the corner. And some of them are already happening. Number 10. Rising interest rates. When central banks raise interest rates aggressively, it's usually a sign they're trying to cool down an overheated economy, but it can also trigger a downturn. Higher interest rates make borrowing more expensive for consumers and businesses, which can lead to reduced spending and investment. This slowdown in economic activity can eventually lead to job losses and lower consumer confidence. Additionally, higher interest rates can increase the cost of existing debt, putting further strain on households and businesses. It's important to monitor central bank announcements and economic indicators to understand the potential impact of rising interest rates on the economy. Number 9. Job layoffs. Increasing major companies announcing mass layoffs. It's often one of the first signs of an incoming slowdown. When businesses anticipate a decline in demand, they may cut jobs to reduce costs. This can create a ripple effect as laid-off workers reduce their spending, further slowing down the economy. Pay attention to news reports and company announcements about layoffs, especially in key industries like manufacturing, retail, and technology. Additionally, rising unemployment rates can lead to increased government spending on social safety nets, which can strain public finances. Monitoring job market trends and unemployment data can provide valuable insights into the health of the economy. Number 8. Inverted yield curve. When short-term bonds pay more than long-term ones, it usually means investors expect trouble ahead. Historically, this has predicted nearly every major recession. An inverted yield curve suggests that investors are seeking the safety of long-term bonds, anticipating lower interest rates in the future due to economic weakness. This phenomenon can signal a lack of confidence in the economy's long-term prospects. Keep an eye on financial news and bond market reports to track changes in the yield curve. Understanding the implications of an inverted yield curve can help you make informed decisions about your investments and financial planning. Number 7. Slumping retail sales. If people are cutting back on spending, even during holidays, it shows consumer confidence is falling. Retail sales are a key indicator of economic health, as consumer spending drives a significant portion of economic activity. Declining retail sales can signal that households are tightening their budgets due to concerns about job security or rising costs. Monitor retail sales reports and consumer confidence surveys to gauge the overall sentiment of consumers. Additionally, changes in spending patterns, such as increased savings rates or reduced discretionary spending, can provide further insights into consumer behavior during economic uncertainty. Number 6. Declining manufacturing output. Factories slowing production equals less demand equals economic contraction. Manufacturing is often considered a leading indicator of economic activity, as it reflects demand for goods and services. A decline in manufacturing output can signal weakening demand and potential job losses in the sector. Pay attention to manufacturing indices and reports from industry associations to track trends in production and new orders. Additionally, disruptions in global supply chains or trade tensions can exacerbate declines in manufacturing output, further impacting the economy. Understanding the factors influencing manufacturing trends can help you anticipate potential economic challenges. Number 5. Housing market freezing. Home sales drop, mortgage approvals stall, and prices plateau. That's a red flag. The housing market is closely tied to consumer confidence and overall economic health. When people are hesitant to buy or sell homes, it can indicate concerns about job security or future income. Monitor housing market reports, including data on home sales, mortgage applications, and housing prices, to assess the state of the market. Additionally, rising interest rates can make mortgages more expensive, further cooling the housing market. Understanding the dynamics of the housing market can provide valuable insights into broader economic trends. Number 4. Rising credit card debt. When people use credit to survive, it's a sign that incomes aren't keeping up with inflation. Rising credit card debt can indicate that households are struggling to cover their expenses and are relying on credit to make ends meet. This can lead to higher default rates and financial stress for consumers. Monitor reports on consumer debt levels and credit card delinquencies to gauge the financial health of households. Additionally, Rising debt levels can impact consumer spending and overall economic growth. Understanding the factors driving changes in consumer debt can help you anticipate potential economic challenges. Number 3, low business investment when companies stop expanding, hiring, or spending. It usually means they're expecting harder times. Business investment is a key driver of economic growth, as it supports job creation and innovation. A decline in business investment can signal that companies are uncertain about future demand and are holding back on spending. Monitor reports on capital expenditures, business sentiment surveys, and corporate earnings to assess trends in business investment. Additionally, changes in government policies or economic conditions can impact business investment decisions. Understanding the factors influencing business investment can provide valuable insights into the health of the economy. Number 2, stock market volatility. Wild market swings often reflect investor fear, and fear is contagious. Stock market volatility can be driven by a range of factors, including economic data, corporate earnings, geopolitical events, and changes in investor sentiment. High levels of volatility can signal uncertainty and concern about the future direction of the economy. Monitor stock market indices and financial news to track trends in market volatility. Additionally, understanding the factors driving market movements can help you make informed investment decisions and manage risk. It's important to stay informed and avoid making impulsive decisions based on short-term market fluctuations. Number 1, consumer sentiment hits new lows when average people stop believing the economy is strong. Spending drops and the cycle accelerates. Consumer sentiment is a key indicator of economic health, as it reflects the confidence of households in their financial situation and the broader economy. Declining consumer sentiment can lead to reduced spending, which can further slow down economic growth. Monitor consumer sentiment surveys and reports to gauge the overall mood of consumers. Additionally, changes in consumer behavior, such as increased savings rates or reduced discretionary spending, can provide further insights into economic trends. Understanding the factors influencing consumer sentiment can help you anticipate potential economic challenges. Are these signs showing up in your country? Let us know in the comments. And forget to subscribe for more weekly breakdowns like this.